63% of Fortune 500 boards now require their CIO to report directly to the CEO on strategic growth initiatives, not just operational performance. That number was 31% 5 years ago. The CIO is no longer the keeper of systems, they are now architects of competitive advantage. Here is what keeps boards awake at night in 2026. A technology decision made in isolation. A cloud migration. An AI implementation. A data platform choice can reshape your entire go-to-market strategy. Yet most CIOs are still evaluated on uptime and cost management. They optimize within a box they did not design. Meanwhile, the business moves forward without them. Revenue opportunities are left on the table. Market entries are delayed. Acquisitions fail because nobody aligned the technology strategy to the deal thesis. The gap between what technology could do and what the organization actually does remains a chasm. And the companies that close that gap first will own the next decade. This is not about CIOs learning to talk like business people. This is about redefining what strategy actually means when technology is the substrate of every business decision. We will walk through 3 frameworks that are already reshaping how the best organizations operate. You will see how CIOs at companies like Grab in Southeast Asia and TCS in India are being embedded directly into M&A diligence, product development, and market entry planning. And most importantly, you will understand the exact shift in mindset and structure that separates CIOs who become strategic architects from those who remain operational maintainers. Let us begin. First framework. Technology due diligence as strategic gatekeeping. When an organization pursues acquisition or enters a new market, the tech audit happens last, if at all. Deloitte's 2025 M&A report found that technology risk was the 3rd most common reason post-acquisition value destruction occurred. Yet CIOs were involved in fewer than 40% of deal evaluation teams. Think about that. You are buying a company, integrating teams, resetting quarterly guidance, and the person who understands whether your systems can actually integrate that acquisition is sitting in a conference room, not at the negotiation table. The strategic CIO reverses this. They lead the tech assessment alongside financial and legal due diligence. Not after. During. Take the example of Singapore-based Grab's expansion into financial services between 2024 and 2025. Before moving into payments and lending, their CIO was embedded in the business case development. Not to validate the technical feasibility, but to identify which technology capabilities would become competitive moats and which were commoditized. That reframing changed the entire acquisition strategy. Instead of buying fintech companies with strong product teams and mediocre infrastructure, they acquired companies with data architectures and machine learning talent that Grab's platform could leverage at scale. The tech strategy became the growth strategy. Your application. Before your next board meeting on capital allocation, ensure your CIO is part of the deal thesis development, not the implementation team, the conception team. Ask them one question. Does our technology roadmap enable this strategy? Or will this strategy require us to rebuild? If it is the latter, the deal economics change fundamentally. Second framework. Platform economics and the technology as revenue model. For the last 15 years, technology was viewed as a cost center with a mission. Run faster, spend less, reduce risk. In 2026, the conversation has fundamentally shifted. According to McKinsey's latest Chief Technology Officer Outlook, Organizations where technology leaders influence revenue generation models are growing 3.2 times faster than those where CIOs focus purely on operational efficiency. The CIO is no longer protecting revenue. They are generating it. This is not about selling software as a side project. It is about baking technology capabilities directly into your core business model and making those capabilities a competitive weapon that creates new revenue streams. Look at Infosys in India. Their CIO and the business strategy team jointly developed what they call the Infosys Metaverse Studio, not as a marketing exercise, but as a technology-enabled service offering that clients could not get elsewhere. By making the CIO a co-architect of the business model innovation, not just the implementation manager, Infosys created a new vertical that is now contributing measurable margin. The technology was not external to strategy. It was the strategy. This is the shift every organization needs to make. Your application. Audit your current revenue streams for each one. Ask your CIO, what proprietary technology or data capability are we leveraging that a competitor cannot easily replicate? If the answer is nothing, then your CIO has visibility to rebuild that revenue stream on a foundation that is defensible. That is the strategic conversation that changes trajectories. Third framework: organizational capability sequencing and the talent moat. Here is what nobody talks about in M&A strategy. Technology infrastructure and talent are inseparable. According to a 2026 IDC study on digital transformation maturity across Asia Pacific, organizations where the CIO had hiring and retention authority over technology talent, not just veto power, retained 84% of high-performing engineers post-acquisition. Organizations where this authority remained fragmented saw a 43% turnover rate within 12 months. The reason is structural. When a CIO is pure operations, they have no say in building the team. They inherit people, processes, and priorities from HR and functional leaders. When a CIO becomes a strategy architect, they control the talent moat. They build the team that makes the strategy possible. That is a fundamentally different lever. Tata Consultancy Services. When they acquired a boutique AI firm in 2024, made the acquired CIO a peer-level strategic partner on TCS's digital transformation roadmap. That CIO then had authority to staff innovation projects across TCS's client base. The result was not integration. It was multiplication. The acquired company's talent did not get absorbed and diluted. It became a lens through which TCS saw all its future technology decisions. Your application is this. In your next organizational design conversation, ask yourself whether your CIO has genuine authority over technology talent acquisition, team structure, and capability sequencing, not influence. Authority. If that authority sits fragmented across HR, the COO, and business unit leaders, your CIO cannot function as a strategy architect. They are still a service operator wearing a bigger title. Fix that structure first, before you expect technology to reshape your growth trajectory. Imagine your organization 18 months from now. Your CIO walks into the quarterly strategy review not as a subject matter expert called on for technical questions, but as a core member of the strategy council. When a market opportunity emerges, they are already in the room. When a competitor makes a move, your CIO has perspective on not just what you can do technologically, but what you can do faster and more defensively than they can. Revenue conversations include technology decisions from day one. Acquisition teams move faster because the tech due diligence is already threaded through the business case. And your best technology talent is not being picked off by startups because they have genuine strategic ownership, not just a job. That is not a hypothetical future. That is how the organizations that are winning in Asia Pacific and globally in 2026 are already operating. The architecture is clear. The examples are proven. What remains is the choice. Will your CIO be a strategic architect? Or will they remain a technology chief optimizing within boundaries they did not draw? If this framework resonated, you already know that the next critical conversation happens inside your organization, not in this video. You need to have a real discussion with your CIO about where they sit on this spectrum. Are they at the table when strategy is being formed? Or are they being asked to execute someone else's strategy? Here is the difficult part. If the answer is they are still in execution mode, the gap is not your CIO's fault. It is a structural design choice your leadership team has made. And that choice has a cost you probably have not quantified yet. Next week, we are breaking down how to audit your technology governance structure to find exactly where strategic authority is leaking away, and how organizations like Shopee have rebuilt their decision-making to lock technology and business strategy together at the hip. That video will give you the diagnostic framework you need. Subscribe to Apex Minds and hit the notification bell. Share this with your CEO or your board. This is not a nice-to-have conversation anymore. It is a survival conversation. Thank you so much for watching this video. If these insights resonated with you, please subscribe to Apex Minds D4J and hit the notification bell so you never miss our weekly content. Share this video with a colleague who needs to hear it. We will see you in the next one. Keep pushing forward. Thanks for listening. If you found this valuable, please subscribe to Apex Minds D4J for more powerful insights. See you in the next one.